without interfering with actual investment projects. Moreover, unlike foreign private equity investments, China's investment hotspots are no longer limited to overseas capital markets. Go-to industries that are more favored, such as TMT telecommunications, technology, and media. Why of them are sunset industries abroad, while in China they may be high-growth industries. For example, chain economy hotels are the most boring industry in mature markets, but China's home-in express hotels are listed overseas with a P/E ratio of over 60 times. 99% of enterprises in Zhejiang are small and medium-sized enterprises. These small and medium-sized enterprises are not high-tech industries, but they make good profits but face financing difficulties. This is also an important stage for private equity investment. At present, overseas investment funds have diversified their choices for the Chinese industry and are no longer solely focused on the Internet. Private equity funds not only changed the financing pattern of Chinese enterprises, especially small and medium-sized enterprises, but also contribute to China's capital market. The field will have a significant impact. In 2006, the Chinese stock market was booming, with the active members being the National Army, mainly public funds and state-owned enterprises. The large number of listings of state-owned enterprises improved the overall quality of listed companies, and the frenzy of public funds directly promoted the prosperity of the stock market. The dominant force in the development of the stock market in 2007 was the Boxer Rebellion, which refers to individual investors. The funds of individual investors are almost twice that of institutions, and their profit margins are also higher than those of institutions. Public funds face challenges such as redemption pressure and investment transparency, while retail investors face difficulties such as information asymmetry and weak risk resistance. The 5.30 crash said widespread distress for retail investors, while institutions successfully escaped. In front of foreign invaders, the National Army and the Boxer Rebellion were defeated one after another. It was the 8th Route Army and the guerrillas who could really fight a protracted war. The 8th Route Army and the guerrillas, which are dominated by private funds, will become the main forces in the capital market in the future. Private funds absorb the advantages of public funds and retail investors, but without too many constraints. And
Fannie Mae and American International Group have also issued an $850 billion rescue plan with twists and turns, and strengthened supervision over the only two major investment banks by incorporating them into commercial banks. Does this mean the convergence of financial leverage? And Geller's judgment is absurd. From the perspective of the disposal method of non-performing assets after major evaporation, it is highly likely that the suit will change without changing the dressing, which is still the Wall Street style of the ultimate goal of $850 billion ESCUE fund operation is TOTTR Act and leverage more private capital and social resources to join in the reconstruction of market order and confidence. This means that the problems caused by the greed of many players on Wall Street will ultimately be solved together by these players. As for the possible changes, whether it is directly controlled by the government, serving as both a judge and an athlete, or investing in private capital investing in non-performing assets, The government's return from the front to the back means that it is difficult for the government to stand on the opposite side of private capital or market players. Mixed operation and joint cooperation may become new features of the next stage of the financial market. From the trend of mixed operation between commercial banks and investment banks, it can be seen that commercial banks have not been spared this time, with the support of investment banks and hedge funds improperly taking on the risk of excessive homebuyers and the excessive debt of investment banks themselves supported by credit products. The combination of the two may lead to further deterioration of the problem. Therefore, after the dust settles, after a period of repair, commercial banks are likely to repackage and sell their investment banking business, and the investment banking model will obviously not end. However, the transparency and leverage ratio of its derivative trading, including executives, will be strictly required and restricted. In fact, entering the financial civilization, the existence and reproduction of financial innovation and financial derivatives has become an important. The economic approach, which undoubtedly has a gambling nature, is inherently guilty of surplus liquidation. Therefore, this requires innovation in trading methods to adapt to the development of derivatives. In fact, the financial crisis is causing the global financial market to fall into painful reflection, making the United States and other countries, including the United States, face the challenge of the Washington Consensus. Although the major countries in the world have coordinated their actions to cut interest rates and inject capital, it is not difficult to imagine that after the crisis, the opening of the financial field of all countries will be cautious and explore the development path of the virtual financial market for the battlefield. In the short term, financial civilization has stagnated, but in the long run, with the recovery of investment banks, confusion between governments and financial institutions, especially the weakening of Wall Street's financial power center, which once dominated the game rules, and a decrease in trust, the international financial derivatives market will eventually become a large casino with relatively open and fair rules, where countries or institutions gamble for high profits. The financial derivatives market is moving towards casino-like, serving as a safe screen for the virtual economy to directly affect the real economy obstacle, adjusting economic imbalances before they harm the real economy, becoming a place for excess evaporation with dissipative functions. But this is only a possible trend in the international financial market, and whether domestic derivatives in China are heading towards casinos, the key to success lies in whether, while accepting the double-edged sword effect and abstract affirmation of financial derivatives, we can leverage the advantages of latecommerce, absorb and learn from them, and improve the barrier role of the virtual financial market. This first means separating rather than mixing. Of course, this is not to say that banks, securities, and insurance are completely in their respective positions and functions, but to set up firewalls to separate high leverage off-balance sheet banking and financial derivative investment business from traditional banking business, in order to ensure the bottom line of deposit safety. In addition, a firewall is set between market failure and human greed. For example, the income of the boss is no longer just the final say decision of the market. Next, improve the order of the casino, ensure fair, just, and open trading rules and information, so that participants can be willing to gamble and admit defeat. The casino-like future of financial derivatives. Another surprising move. On the last day before the National Day holiday in 2008, China Securities Regulatory Commission, it will be announced that the pilot work of securities companies margin trading and short selling will be launched. Although it has been brewing for a long time and can be expected, the timing is completely contrary to the current world trend. After all, developed countries are using restrictions on short selling to cope with financial collapse. After all, as a kind of financial derivatives, after the subprime mortgage crisis exposed the fraud and destructiveness of derivatives, the bankruptcy of Lehman caused countless investors to lose all their money and exposed the nature of zero-sum game and gambling of derivatives, which almost the product has been pushed into the abyss of eternal doom, and it seems that compared to human rational needs, used for hedging and pricing, it is more catering to people's greedy desires. Obviously, China's launch of margin trading and securities lending at this time inevitably raises concerns about its future role in the stock market and even the economy. Under the global financial crackdown, people often have excessive vigilance and insufficient understanding towards financial derivatives. Draw elephant excess, specific deficiency. The crisis has fully demonstrated the double-edged sword effect of financial innovation, but in essence it is the expression of the original sin of the market economy embedded in financial activities, and it is a normal stage of the development of the market economy. The so-called original sin refers to the surplus caused by the production of market economy entities for exchange, and the surplus needs to evaporate. Firstly, the emergence of early financial derivatives such as futures, certificates of deposit, and European bonds, although either for hedging, risk avoidance, or financial regulation avoidance, was mainly due to the inability of normal investment opportunities to provide a way out for the large amount of capital accumulated by industry and commerce at that time. It was the relatively excess currency that stimulated financial speculative activities. On the other hand, the data shows that at present, 70%至80% of the global liquidity is caused by derivatives trading every day, and the scale of the global derivatives market has reached 8 to 10 times of surplus liquidation. Therefore, this requires innovation in trading methods to adapt to the development of derivatives. In fact, the financial crisis is causing the global financial market to fall into painful reflection, making the United States and other countries, including the United States, face the challenge of the Washington Consensus. Although the major countries in the world have coordinated their actions to cut interest rates and inject capital, it is not difficult to imagine that after the crisis, the opening of the financial field of all countries will be cautious and explore the development path of the virtual financial market for the battlefield. In the short term, financial civilization has stagnated, but in the long run, with the recovery of investment banks, confusion between governments and financial institutions, especially the weakening of Wall Street's financial power center, which once dominated the game rules, and a decrease in trust, the international financial derivatives market will eventually become a large casino with relatively open and fair rules, where countries or institutions gamble for high profits. The financial derivatives market is moving towards casino-like, serving as a safe screen for the virtual economy to directly affect the real economy obstacle, adjusting economic imbalances before they harm the real economy, becoming a place for excess evaporation with dissipative functions. But this is only a possible trend in the international financial market, and whether domestic derivatives in China are heading towards casinos, the key to success lies in whether, while accepting the double-edged sword effect and abstract affirmation of financial derivatives, we can leverage the advantages of latecommerce, absorb and learn from them, and improve the barrier role of the virtual financial market. This first means separating rather than mixing. Of course, this is not to say that banks, securities, and insurance are completely in their respective positions and functions, but to set up firewalls to separate high leverage off-balance sheet banking and financial derivative investment business from traditional banking business, in order to ensure the bottom line of deposit safety. In addition, a firewall is set between market failure and human greed. For example, the income of the boss is no longer just the final say decision of the market. Next, improve the order of the casino, ensure fair, just, and open trading rules and information, so that participants can be willing to gamble and admit defeat.
Along the cycle. 2. How two standout enterprises are already destined to die or live, and the so-called fate appears to be determined by personality, while the essence is but it was caused by original sin. In a macro sense, original sin refers to the inevitable trend of market economy development towards surplus, which requires evaporation and liquidation in order to restore the dynamic equilibrium of the market. In the micro sense, original sin refers to the ambition and greed for excessive profits in human nature that lure enterprise. into unconsciously falling into a trap, either for the sake of competition. In the words of the boss of Zhejiang Oaks Group, only by keeping opponents awake can I sleep. Either we strive to become bigger and stronger, desperately building big ships, resulting in overproduction in society. From this perspective, micro-original sin is the source code of macro-original sin. Once the original sin is indulged, the consequences are very serious. The most classic is that the greed of investment banks killed Wall Street. In addition, big trees catch the wind and see. Companies that are too powerful are prone to political repair. When choose buttons account for 90% of the world's buttons, lighters account for 80%. And umbrellas account for 80%. After killing all its competitors around the world, it was discovered that the other government was already holding a big stick and preparing to deal with him. Faced with political dominance, most companies can only lie down on the spot. When a company is still in its childhood, its fate is basically the boss's mind, vision, courage, legal intelligence, etc. Diagonal lines of various human elements. On the one hand, the growth of enterprises often benefits from the resilience and drive of bosses who do not abandon or give up. On the other hand, the limitations of the boss themselves also affect the life and death of the enterprise. For example, when two small bosses have strong tactics, courage, and the courage to make quick money, but generally lack strategy, and the transformation of enterprises is simple and blind. This may not be a bad thing for individuals, but for enterprises, it may evolve into disasters under specific conditions. Due to the emphasis on tactics over strategy, and the emphasis on the immediate and long term, the crisis was scattered and scattered. It can be said that the fate of small and medium-sized enterprises is roughly the materialization of the boss's personality, a microcosm of his personality, and on a company is tempted by the original sin and strives to grow and strengthen. Its fate begins to deviate from its boss or the control of entrepreneurs, accepting various external shocks such as industry prosperity, market cycles, policy adjustments, and international crises. At present, enterprises are generally facing three knives. One rope, which refers to cost increases, exchange rate fluctuations, and foreign trade. Future countries will be extremely sensitive to food prices, and control the rise in grain prices will become the focus of policies in various countries. In the short term, international grain prices may rise or fall due to the government's efforts to control the situation by increasing energy market supply and introducing subsidy policies. But food prices have actually embarked on the irreversible path of oil prices, and what countries are doing with oil prices now may follow suit in the future. Oil prices have prompted countries to jointly reflect on energy policies. And future food prices cannot be fixed by a single country adjusting its policies. Multiple leaders have engaged in a food summit, but measures to stabilize food prices in various countries may be resolved through genuine interests. More importantly, unexpected events such as natural and man-made disasters, financial turmoil, etc. will increase the dispersion of future food prices. As for whether international grain prices will rise and fall, whether they will remain at a high level or return to normal, it depends on the combined force of various uncertain factors, especially whether countries can reach a consensus on the issue of grain prices consistent. Nowadays the oil price has not yet unified the front line, and the solution to the food price problem is clearly even more elusive. Therefore, in the long run, both the country and the market will keep up with food prices, and international organizations may play a greater coordinating role. And China has clearly become an oasis in this food price tsunami. The increase in domestic grain prices is relatively flat stable, with an increase of 6.8%, 7.4%, and 11.4% from March to May, respectively, because the self-sufficiency rate of grain in our country is as high as 95%, and the 150 to 200 million tons of grain reserves make the Chinese people have food in their hands and have peace of mind. More importantly, China's grain prices have not yet been liberalized, and the firewall of price controls has isolated the soaring international grain prices. In addition, the government has taken measures such as transferring grain from the north to the south, reducing exports, and raising the minimum purchase price of rice and wheat, so that China has not fallen into the vortex of the international food crisis. But after all, the current prices of rice and wheat in China are only about a quarter and one-third of the international prices, and the gap between domestic and international grain prices is constantly accumulating upward. Why? In order to stabilize food prices since March, China Storage Grain Corporation and COFCO Group have sold wheat and rice in, missing at least one major market trend. Secondly, there are two more common reactions that still see the temptation of PE. One is to continue to bet on the future market responding to changes with immutability, hoping that capital operation can reverse the decline of the industrial economy, but only maintaining the fate of the enterprise on the PE strategy, with huge risks. Another approach is to use PE fundraising from the perspective of enterprise development strategy, seize the industry's commanding heights, and strive to stabilize and expand the enterprise as much as possible. The two will jointly invest in the high end of PE and VC. The problem with this trend is that it is difficult to achieve sustainable development of projects based on the current composition and constrained system of personnel engaged in PE and VC in China, because even practitioners of PE and VC rarely persist until 7 years. Often, if there are projects with money, they will gather. If the money goes out, they will disperse. And there are many people who do one vote and end it. Under these conditions, uncertainty risk has become the primary risk, besides operational risk, which is also a distinctive feature of China compared to international standards. Since PE is always a kind of financial innovation, with the essence of financial greed, it is embedded with the fast evaporating original sin. The chaotic phenomenon of PE burn-in G-money under the concept hype has emerged. Even those who are as skilled as Blackstone will inevitably be mistaken for their wisdom. Originally, when the global era of low interest rates was coming to an to whom do companies entrust money entering 2008? Chinese enterprises not only fully enjoy the fruitful results of 30 years of reform and opening up, but also face unprecedented challenges, some confusion. On the one hand, the economic prosperity has brought excess liquidity, which is mainly reflected in the large amount of capital accumulated in the hands of low value-added export processing enterprises such as textiles and shoes, as well as the excess capital brought to enterprises by the capital market explosion, and the withdrawal capital of untraded shares and enterprises. On the other hand, the situation has undergone a sudden change, with the continuous appreciation of the RMB, rising labor costs, and the adjustment of export tax refunds superimposed. The transition from hot to cold in the real estate and stock markets has forced enterprises to abandon their original production methods and investment digestion channels. As a result, wealthy enterprises suddenly have no direction and are forced to seek non-traditional financial management methods. At the same time, financial civilization has impacted the Chinese coast more and more. Monopolizing venture capital, VC, and private equity at its forefront, investment PE has caught the attention of investors, attracting billions or even tens of billions of converted capital, excess capital, and exit capital, with the wealth creation effect of several dozen to 20 times. Especially since the implementation of the newly revised Partnership Enterprise Law in June last year, there have been at least hundreds of VC and PE companies operating in the Jiangsu and Zhejiang regions alone. However, with the failure of Donghai Venture Capital, the first private PE in Wenzhou, and the issuance of the guiding opinions on the transfer of restricted stock of listed companies by the China Securities Regulatory Commission, the future of enterprises entrusting money to PE and VC remains uncertain. For one thing, Chinese-style PE itself cannot escape the fate of excessive hype and burning money on portal websites back then. In the United States, PE is an efficient factor integrator, is a professional who is proficient in finance and possesses solid skills in enterprise operation and business expansion. Under the premise of low market efficiency in other investment and ownership models, they successfully reduced the cost of capital through public listing. Unexpectedly, when the subprime mortgage crisis broke out, the stock price plunged and the market value evaporated. Therefore, the third major trend will be for a few companies that penetrate the essence of PE to choose to grow their own industrial chain and become masters of their own capital. Enterprises, and there, instead of completely entrusting money to unstable institutional investors, it is better to consider PE as an integral part of one's own enterprise development strategy. Occupy PE resources as much as possible, and leverage the full integration of PE to complete one's own strategy. achieving various dimensions and directions of movement. Please pay attention to FUCA analysis, how small and medium-sized enterprises for specific content and work together to create an industrial chain and even an ecosystem with core focus.